Today's question in the Ask James Wise series comes from Candace Moran. Candace asks, hashtag Ask James Wise. Thank you for using the hashtag, Candace. Some of you guys are getting a little lazy and using the hashtag Ask James Wise. Make sure you put that in your questions. I said I wasn't going to answer any questions unless you pump that in there. I've kind of gotten away from that. But I digress. In September, my husband and I bought a home. Today I received a bill for my taxes in the mail. I thought I was paying my taxes wrapped in with my mortgage and insurance. Is there something I'm missing here? Also, aren't taxes paid after the fact? So being I moved in September, would I be responsible for the entire portion of that tax statement, or would the previous homeowners be responsible for a portion? Thanks in advance. Great questions, Candace. Let's knock out the easy part first. The insurance and the taxes being wrapped into your mortgage. It is very, very common that taxes and insurance are escrowed in your mortgage. What that means, you see, your mortgage, technically your mortgage is actually only two things. Your principal and your interest. The money you borrow from the bank plus the interest that they make to loan you the money. Make sense? That is usually a much smaller portion of your total payment that most of you are used to paying, because most banks require you to escrow the taxes and the insurance. They do this to ensure that you are protecting their asset. Remember, they loaned you the money to buy the house, so they need to make sure that you're insuring the house and that you're paying taxes. Because if the government forecloses on that property because you're not paying your taxes, well, they risk losing their money. And if your house burns down, they're the ones who put the majority of the money into it, so they can't have that happen, so they're going to force you to get insurance. So, most banks are going to escrow it. What it means is you're paying a higher amount and they're holding that in an escrow account, and then at the end of the year, they pay the taxes, they pay the insurance. They want to make sure those things get paid. Not every single lender sets up their loans that way. So you need to check into your loan, call your loan officer, see if your taxes and your insurance are escrowed in there. If they're not already in there, you'll have to separately pay your taxes to the government. You'll also have to separately pay your insurance. Speaking of insurance, this is a great time for me to mention that this video is actually brought to you by the Hogue Insurance Agency. The Hogue Insurance Agency is a local insurance company out here in the Cleveland, Ohio market. They can handle insurance of any kind, auto, home, life, even health for the entire Ohio market. Please reach out if you need an insurance quote today. I personally think it's easier for folks to have the insurance and the taxes escrowed. So if yours isn't escrowed, I would actually recommend you go ahead and do that. It's just simple, it's clean. You have one bill, you don't have to worry about it. Chasing down 3 different bills, that's kind of a pain in the butt. Now the second part of your question about having to pay the taxes. Now this confuses or trips up a lot of new homeowners and home sellers. The thing about taxes is they're actually paid 6 months in advance. So for easy math, let's say you purchased a home in January of 2018. You're going to get a tax bill, okay, in January. But that tax bill is not for your taxes from January to June of 2018. They're actually from June to December of 2017. That's when you didn't own the home. So you're probably looking at this bill like, whoa, whoa, I bought the house in January. I shouldn't have to pay the taxes from June to December of 2017. I understand that. If you look at your closing disclosure when you bought your house, are you still there? Are you still with me? If you are still with me, pound that like button real quick before we get back into this. Did you pound it? What about now? All right, so it's called a tax proration. Your title agent should have done a tax proration. What that means is, let's say you had to bring $100,000 to the table to buy this house, and the property taxes were, let's just say $1,000, okay? What they would have done is they would have given you a credit. So instead of you bringing $100,000, you only would have had to bring $99,000 to the table, because the title company credited that to you, because they know after you buy this house, your first tax bill is going to be for the time period that the previous owner had owned the property. Well, Candace, I hope that answers your question. For the rest of you, if you have questions, feel free to drop them in the comments section of the Ask James Wise video. We're going to go out and make a video just like this one, answering your question completely free of charge. Make sure you're subscribed to this channel for more great content like this. please show me the love, pound that like button, share it with your friends, tag someone you know. If you want to follow me, my personal story as a broker, investor, and entrepreneur, you can do so on my Instagram at JamesWiseHWPG. As always, I'm James Wise with Holton Wise, Real Estate Investing Made Easy.